Welcome. This is Bernie Zuzo. You are at webinar number 6, Financing Technology Ventures. This is the last topic in a 6-part series on technology entrepreneurship, which TRDA has had the privilege to develop. It's my pleasure today to introduce our moderator for this particular topic, Kirsty Chadwick, who is the principal at Growth Innovators, and she is also the executive in residence at TRDA's incubator here in Melbourne, Florida. Kirsty, I'd like to turn it over to you.
Thanks, Bernie. I, in turn, would like to thank this wonderful group of panelists that have agreed to come forward and spend time with us here today, going over the topic of funding technology companies. And to set the stage for this session, I want to define what funding technology, or what this webinar will be focusing on mainly. In past webinars, there were discussions around tax credits and grant funding and some other types of funding that are options for early stage technology companies. This particular webinar will dive into what's called equity capital, which is angel and venture capital sources of funding for early stage technology companies. With us here today, I have 3 panelists. The first is Mark Moeller. The first is John Igo. John is a partner with Edwards, Wildman and Palmer, a law firm down in South Florida. We've invited John because he has extensive experience doing early stage deal transactions, equity transactions for angel type angel groups, as well as venture capital deals, and can talk at length about the legal side of this, the terms that go into a term sheet, and the documents that are involved in what's involved with the transaction. John is also an angel investor himself, so he can also chat about the investor side of the equation as well as the legal side. Next, we have Mark Moeller. Mark was with us at the last seminar, and Mark is a founding member and managing director of Rotation Renewables, where he's responsible for strategic planning, partnerships, and overall management of the company. He has extensive experience in the formation, funding, development, and management of clean tech companies in particular, and he's participated in a variety of venture and private equity-backed clean tech companies as a senior executive. And then last but definitely not least, we have Casey Swerchek. Casey is with Hamilton Lane, which is a private equity firm out of Pennsylvania. And Hamilton Lane was selected by the state of Florida to manage what's called the Florida Growth Fund, which is a $250 million fund that was allocated by the state to be put to work into early stage technology companies here in Florida. So in translation, that means he's a venture capitalist, and a very, very good one, and he's here to share the perspective of venture capitalists and what's expected of companies when they do a venture capital transaction. Before we get started, though, I wanted to just set the stage a little bit about where equity capital comes into play. There are a lot of different types of small businesses in the United States, and in fact, the vast majority of job creation in our country has come from small businesses over the course of the years, all the way back to World War II, in fact. And but there's different types of small businesses, and the type of capital that is best suited for them differs depending on what type of company they are. So the first category is called a lifestyle business. That's a family-owned business or a small business, maybe a niche restaurant or an accounting firm. These are businesses that can be very successful and create great wealth for the founders and the key principals, but they would not be eligible in most cases for venture capital or angel investing just because of the nature of what they are. Generally, the founders of these types of companies like to be involved for many years, if not their entire career, and therefore there's not a exit, which we'll talk about more, but that basically means you're going to sell the company or go through an IPO, and these types of founders generally don't want to do that. The next category is a growth company. So this is somewhere in between a lifestyle business and an investor-backed company. And these companies do have growth, but they generally try to keep it private, owned by the founders or owned by employee stock option pools. If they do bring in investors, their mission is to pay them back, so it's a different kind of an investment transaction than an equity deal. Might be a convertible note or some sort of a high interest loan, and they're on a mission to pay those investors back so they don't have to exit out of those companies in the form of a sales transaction or an IPO. And then the last type is the type that we'll be focusing on here today, which is investor-backed companies, which means that they're getting their early-stage growth capital from angel or venture capitalists or potentially private equity groups in the later rounds. And these require an exit just by the nature of how the capital transaction works. And so as part of your thought process here on whether you should be pursuing venture capital or angel investment for your company, one of the first things you should be doing is thinking about what your long-term plans are for your company and whether you are open to selling your company in somewhere between 4 to 7 years out and potentially bringing in others to help that can basically take control of your company if things don't go well or if your objectives begin to differ from your investment teams. So with that, I am going to turn the floor over to Mark, who is going to introduce us in a little more detail to the different sources of capital and dive in a little bit more on what an angel investor is and what a venture capital is. So with that, Mark, I'll turn the floor over to you.
Thank you, Kirsty, and good morning, everyone. Kirsty asked me to spend a little bit of time talking about the broad categories of funding for new ventures, and I know many of the participants on the call came through the process of the TRDA Clean Tech Ventures program, and my experience over the last 10 years in entrepreneurship, law, and finance is specific to that sector in many cases, and so some of the things I'll highlight will be specific to the clean tech category because that is very much its own animal, so to speak, for purposes of corporate finance. And what we see on this first slide are the broad categories of the ways in which you can fund a business, and Kirsty just mentioned that one of those ways is bootstrapping, which is simply a term used to describe funding your business without any external help. And so the first two categories of personal funds and credit cards are common ways to do that. As you reach out beyond your own funds and the funds of the founders, you might commonly go to friends and family, and some of our more cynical brethren might refer to this as the 3 F's, which is friends, family, and fools, but hopefully that's not the case. Then you get into the category of debt, and once upon a time banks used to loan money to companies, but we'll get into a little bit of detail on where the status of that is. And increasingly, because of some of the absence of liquidity and finance in the financial marketplace today, you're seeing strategic partners, customers, and strategic alliances form for purposes of getting your business started, so that the ultimate users of your product may be sources to help finance the business if they're interested in getting access to that. And then in terms of equity investment, these categories, it's a very dynamic sector, and I would say that these traditional categories that we have here are increasingly blurred. But we'll talk about angel investors and new super angel investors that have developed largely through the internet. Family offices, which is a increasingly influential category of investor, and family offices are simply professional investors similar to a venture firm that professionally manages money, but does that on behalf of typically a single large wealthy family, multi-generational wealth, or in some cases a combination of a pool of family wealth through what's referred to as a family office. I point out that in the clean tech sector, this is an increasing source of capital investment because unlike venture capital and other types of private equity sources that have fixed fund lives and certainly time periods over which they typically would like to, or family offices typically have none of those limitations, so they can be very flexible in the period of time over which their investment sits in your company. They can be very long investors in ways that funds with fixed lives cannot be. The other thing is that because they're ultimately controlled by one or more single families, they have the ability to be very flexible on the form of the investment. So it also doesn't have the limitations that you often see with venture capital firms that need to have an equity investment reflecting equity risk. You can have a lot of combinations of investment, and increasingly these family offices have an emphasis on sustainability businesses. So they've become very active in the clean tech sector. So I'd encourage everyone, if you haven't looked into this category before, especially those of you in the clean tech sector, to consider looking into family offices because of all those factors that make them a very successful niche investor. We'll talk about traditional venture capital, and again, the line is getting blurred a little bit in this respect too. We'll talk with a little more specificity, and Casey with a lot more specificity about how these investors see opportunities and invest in opportunities. But increasingly, you're seeing venture capital firms even managing state or federal dollars. And again, in the clean tech sector, for those of you in Florida at least, you should know about the Florida Opportunity Fund, which is ultimately federal dollars from the Department of Energy, which are being invested through a professional venture group into clean tech businesses in Florida. The other category that's increasingly active is often referred to as corporate venture capital. So similar to a strategy where a strategic partner or one of your customers finances your businesses, increasingly corporations, which are very cash heavy right now, are reaching out to do their own type of venture investments in areas that are either related to their business or similarly related to something that they're just generally interested in or their shareholder base supports. In the clean tech field, again, a good example is Google. Google has a tremendous amount of investments in renewable energy projects to the tune of billions of dollars. So that's an increasingly significant player. And then finally, you have traditional private equity, which tends to be a later stage investor and acquirer of control of your company, which oftentimes is part of an exit or a staged exit. So with that, I would say those are the broad categories of sources of traditional funding. And so our next slide is just indicated to make the point that if you're going to sell equity in your company, you're actually selling a piece of the company, ownership in the company, like any other asset. And you're going to have minority or perhaps even majority owners of your company that you're taking on. And as owners of that company, they typically will be around until you have some type of exit for either everyone in the company or that particular investor as an investor. That's differentiated from someone who's going to simply loan you money and not take an ownership and position in your company. You like a bank, and we'll talk a little bit more about bank lending on the next few slides. I point out the convertible note bullet under debt, which is a hybrid of those two things. It starts out as debt, but it may well, at the election of the lender, become equity. For debt financing tools, the broad types of loans, term loans, where you have a period of time over which you need to pay back and amortize a loan, lines of credit where you can draw against and reborrow, letters of credit, which are most common in international trade transactions where you have a financial institution typically associated with an international buyer putting forth an irrevocable obligation to pay upon delivery. Short-term notes, business credit cards, all typical ways and traditional ways in which founders have found ways to finance their businesses. But banks are very risk-averse lenders. Traditionally they are, and since the economic fallout, they really, really are. And so in many ways, these credit markets have evaporated since 2008. And increasingly, it's difficult for business owners and certainly early stage business owners to find access to lending from traditional funding sources. In the clean tech category in particular, government and state programs have tried to fill this void. And there are a variety of programs that seek to provide credit enhancement through government guarantees. So in other words, the clean tech companies tend to require a tremendous amount of capital, and that capital is not available because banks are risk averse and can't find a way to lend and get comfortable lending. Well, the government has stepped into that void in the clean tech sector, most commonly through the Department of Energy and through the Department of Agriculture, to provide a credit enhancement by backing a certain percentage of that obligation and saying, well, if this company fails, we will pay. And that has been extremely useful historically in the last several years in getting some of these deals financed. The caveat on this one is that right now in this cash-constrained environment and federal budgetary process, these credit enhancements are receiving a tremendous amount of scrutiny. And so in the Solyndra deal in the solar sector, for those of you who are familiar with that deal, has only heightened that scrutiny. That was referred to as a Department of Energy loan guarantee, but it was actually a direct loan. There was no financial lender in that. So the availability of some of these credit enhanced loans in the future is going to be a subject of a great amount of debate over the next several months. So if lending is tight and oftentimes not available to you as an early stage business owner, let's try to find some things that are perhaps a little bit more optimistic. In selling a piece of the company to a person buying equity, what types of things is that investor from any one of these categories going to look to? Well, it's predominantly a return on their investment, obviously. They want to make sure that they're going to get some type of benefit from having taken the risk of putting money into your business. They need a product, management team, and a big market. The easiest way oftentimes for an early stage business to find that outside investor is through angel investors, which is a category generally used to describe simply wealthy investors. They're SEC accredited investors, so the laws permit them to make investments in non-public companies and non-public registered offerings. And many times they're successful entrepreneurs. In many cases, the amount of the investment is not a large or extensive one, $25,000 to $250,000 per angel investor. And some of these are club investments and sidecar investments where various people put in various amounts of money, and it could differ. There's more than 400,000 active angels in the United States, and that number is dramatically increasing because of some of the things that are happening that are pretty exciting in the sector. One of those things is the concept of crowdsourcing. And crowdsourcing is really an internet phenomenon where, crowdfunding, which is based on crowdsourcing. And crowdfunding is an internet phenomenon where you can find access to both accredited investors and in some cases non-accredited investors over the internet who have an interest in a particular business or category. Angel List is a website that early stage companies can go and register their company, and investors who are supposed to be pre-screened as accredited investors have access to funding your company based solely off of making that match over the internet. And this crowdfunding phenomenon is largely arisen out of the really low cost that it now entails in order to start a business. The way technology has advanced to the stage where you don't need a lot of capital, especially in some sectors like IT, compared to what you needed even 5 years ago to get your business started. And many of these investors are super angels that often aggregate around a database like AngelList, are looking for those types of companies where they can very easily write a check for $25,000 as part of a larger group and have tremendous potential upside on an early stage business. Likely not something that will work for high capex businesses like what you see in the clean tech sector. But for something like IT or something where you don't need a lot of money to get through the first stage of your company, it could be something that's interesting. There is a a current piece of legislation on crowdfunding, which would allow investors to invest up to $10,000, or as long as that doesn't exceed 10% of their annual income, without any type of SEC accreditation. So and that bill actually it's one of the few things on the Hill that has bipartisan support. So it was proposed in the jobs bill by President Obama, and it's subsequently been picked up by the House of Representatives, which is Republican controlled. And so many people think that this type of funding is going to be permitted legally. Whenever you have an equity investment, you always have to consider the legal ramifications of whether you're able to take that money under SEC rules. And if this bill passes, the crowdfunding type of technique of simply going out, putting this on the internet through a web page like Kickstarter, for instance, and having people that you don't know that may not be qualified as accredited investors invest in your company through crowdfunding could be something that in the very near future becomes both legally sanctioned and highly available. So it's an exciting time for things like that. The next slide here is we're advancing through. Here we go. It's simply a graph that shows the increasing number of American angel groups. So these are club groups that they get together that are typically, again, accredited investors, high net worth individuals that form investment clubs, and there's several in Florida that you should be aware of that Kirsty can certainly speak to that are very active in this area. Running low on time on my presentation. So this next slide is something you can take away. It just shows general amounts and volume of investment. So what is a venture capitalist? A venture capitalist is a professional manager of other people's money. So different than an angel investor that is investing his or her own money. This venture capital category are professional managers of money, typically money raised from limited partners that are either pension funds, corporations, or high net worth individuals, and typically specialized to a category. Clean tech saw a tremendous amount of venture capital investment over the last several years. That herd is starting to thin. In the clean tech community, we're seeing a high degree of specialization with venture firms. Many firms that were generalist firms that made some investments that haven't necessarily panned out well in the category are leaving the category. And again, you're seeing that void filled by family offices and other players. And in the venture community, you're seeing highly specialized clean tech investment funds. And others in the presentation will speak with more specificity to this investment category. That's it for me, Kirsty.
Okay, Mark, thanks. There were a couple of other slides in this section. I'm going to quickly cover one of them. I'm going to turn the floor over to Casey to talk about valuation. So let me quickly go there. One little side note for folks to think about, because here at the TRDA we get a lot of folks coming in wanting to understand how to access venture capital, and back to Mark's comment about the number of angels and the growth of that particular category. This chart was interesting, and granted it's a couple of years old, but also keep in mind this was during the the economic downturn, and yet even in that year, looking at the comparison of the total amount of funding that went in from angels versus VCs, is almost the same amount, and a lot more deals were done by angel investors versus VCs. So it's something for those of you who need smaller amounts of capital to think about with respect to angel groups. Here in Florida, we have an interesting phenomenon. There's a thing called a funding gap, and this is true all over the country, but it's particularly painful here in Florida. So for those of you that are in your first rounds of capital pursuit, you might need to pay attention to what amount of money you're asking for. Somewhere between $250K and $1.5 million. It could potentially be swung by angels or a syndicate of angels. But VCs generally like to go closer to $5 million. I'll let Casey talk about that more because there are some exceptions, but for the most part, they're looking to put large amounts of capital to work. So if you're looking for $3 million in funding, you are sitting right here in this red zone, in this gap. So before you go too far down the path of for asking for that amount of money, you may want to just have some dialogues with some folks that understand how this equity capital mechanism works here in Florida, and just make sure that your company's in a position to be able to attract that range of funding, because you're somewhere in between the angel groups and the VCs, generally speaking, when you're asking for that. Just some tips on how to fill that gap. Go get some early stage capital and use it wisely. That's the net, because you're going to have to probably use it to get through the gap. And you can go after strategic partners or some SBIR funding or some other things, but just be sensitive to the fact that early stage rounds need to be used wisely and cautiously in order to get your companies to the point where they're positioned for the VCs. Okay, valuation. Casey, as a venture capitalist, has quite a bit of experience on this particular topic. And for those of you that are new to this equity investment world, what valuation basically means is how much is your company worth. As entrepreneurs, generally you obviously are passionate about your companies and your businesses, so therefore you think they're worth a ton of money. Yet from the world of the investors, or from the perspective of the investors, you're a huge risk. So they look at it very differently. And so Casey, I'd like you to spend maybe 15 minutes or so walking through just the basics of how a venture capitalist or an angel would value an early stage venture.
Sure, absolutely. Good morning, everyone on the phone. Thank you for joining. Again, thanks to everyone else on the panel for joining today. Mostly thanks to Kirsty for organizing this and doing such a great job in the early stage and startup community here in Florida. So starting with the next slide on page 19, we've got just a general way to think of the risk-return spectrum for venture capital firms. And there's been sort of a little bit of a change to this, I'd say, over the recent history, in trying to diversify a portfolio away from being so heavily concentrated on home run type of exits. But in general, what you're seeing in front of you is the structure of the way a venture capital firm would, or venture capitalist would, think about their portfolio and how they generate returns for their limited partners. On average, about 50% of the deals that they're investing in, and in this case it's 4 out of 10, 5 out of 10, you're expecting a complete loss. Those are companies that you're investing in. They're in early stage. There's significant technology risk that the technology fails, or someone beats them to market on the technology. There's significant management team risk, and the management team isn't the right team to kind of execute the strategy. There's any of a number of risks that stand in the way of a company becoming a successful investment for an angel investor or a venture capitalist firm, and having a 50% loss ratio for even some of the best and brightest venture capital firms that are out there. Name any firm in Silicon Valley, I'd say that's probably about average. And so you have significant risk that you have to overcome, and significant write-off ratio that you have to overcome to generate a solid return on the portfolio. Beyond the complete write-offs, you see here break even on 2 to 3 of those investments, and kind of the venture speak, those are singles and doubles. You're expecting to get your capital back. And again, have to keep in mind sort of the time horizon over which venture firms invest. At an earlier stage, you're expecting cash to come back kind of over a 5 to 7 year period. At a later stage, it's a little bit shorter end date with 3 to 5 year expectation. So to have capital at work for 5, 6, 7, in a lot of cases, as we've seen with the limited IPO markets over the last couple of years, you have some investors that are still carrying portfolio companies in their portfolios from 2000, 2001, 2002. So 10 years of hands-on management, of working with these management teams, of really trying to build the value of these companies. and at the end of the day, returning the capital is not a good outcome for anyone. So you've got a few deals that are in kind of this 2 to 3x cash on cash return. So again, cash on cash just simply is the amount of money returned upon liquidation of your investment over the amount invested over time. And so referring to those mostly as doubles and triples. Those are typically making up a very small part of the overall portfolio for venture capital firms. And then finally, the last is home run deals, and these are 10x cash on cash returns, sort of very rare not unexpected, but hard to achieve type of exit event, and certainly the thought is that those one or two deals that are in this home run category sort of carry the day for the venture capital fund. Again, the hope is that if you're a limited partner in these funds, to significantly reduce or find managers that are significantly reducing or minimizing the first two categories of complete loss and break even, and trying to maximize sort of those 3x to 10x and then certainly above 10x returns. But this is an important way to think about venture capital investing and understanding the perspective of how a venture capital firm looks at their portfolio and decides how to meter in capital over time. Again, knowing that these are the average portfolio statistics, it kind of plays into the frame of reference of the venture capital firm on how they invest into companies over time, rather than sort of breaking off large pools of capital or chunks of capital for deals early on. There's much more of a transition to managing and mitigating this risk and metering capital into companies slowly over time, and really separating very early on the winners from the losers in the portfolio, and continuing to fund those companies that are doing well, and further reduce this risk ratio. So the next slide, we've got a couple of equity investor terms, and I'll walk through these very briefly. This can get somewhat technical, but we'll try and keep everything high level and conceptual today. Pre-money valuation, simply the value of a company before an investment. I'd say this is one of the ultimate issues we see with early stage companies in the market here in Florida as they approach us, is sort of determining a pre-money valuation before really having significant conversations with venture capital firms, with angel investors. Ultimately, the value of a company is what investors are willing to pay, and not set by management teams, but it's usually set in tandem with a management team. But the pre-money valuation is simply, the way to think about that is the value of the company before an investment round is made, and then simply post-money valuation is taking that pre-money valuation, adding to it the amount of capital that's being raised in the round, and coming up with a post-money valuation. The fully diluted number here, or term here, it refers to the number of shares that are within a company. Mostly this refers to stock option pools, and any warrants. If there's debt in the company or bank lending, there's typically warrants that are granted to those lenders, and those are not always calculated on the capitalization table for the company. Fully diluted means when you actually consider those shares as active. Return on investment, dollar amount of return on investment. This is, as I mentioned before, cash on cash return, same thing. The amount of dollars received after liquidation of an investment relative to the amount of capital that went into the investment over time. IRR is more of a apples to apples way that limited partners like to look at their rate of return in comparison to other asset classes that they invest in within their portfolio, and so that would include equities, fixed income, bonds. Those are all sort of measured on a time rate of return basis, and so an IRR calculation simply allows the private equity asset class to come up with a return that's a little bit more apples to apples. Terminal value, the projected value of the investment at exit. So whenever you go to sell the company, this is what the ultimate exit price is when a strategic acquirer or a financial acquirer buys the company, and is typically set based on a combination of comparable transactions within the market, or a comparable multiple of either EBITDA or revenue of the company compared to publicly traded comps. And the market cap of the company is simply very similar to, or exactly the same rather, as in the public markets. This is the total value of all the outstanding shares multiplied by the price per share. So pretty straightforward calculation. On the next slide, we walk through the return on investment and IRR criteria, and so again, what is the goal? What is the goal of this asset class of investing in venture capital for limited partners? Certainly, the goal is to maximize return. It's a high risk, high return asset class. It's one that is highly illiquid. You want premiums for both the risk taken and the illiquidity of the asset class. And so the goal is to sort of meet or exceed typically a public market index by a certain percentage. I would say for venture capital, I haven't seen any specific indices that limited partners within these funds typically track. They prefer to look at their private equity portfolio overall, so I can comment on that. I would say typically for private equity overall, the goal is to take a broad market index such as the Russell 3, the Wilshire 5000, or S&P 500, and beat that index by anywhere from 5% to 10%. On an annual basis, and so the way to achieve those returns is to be able to get to an exit point within a short period of time, relatively short period of time. Venture capital firms typically looking for that exit within 3 to 7 years. Angel investors typically tend to be a little bit longer dated in their returns and be a little bit more patient. And then adding in some of what Mark said about corporate venture groups, which certainly we've seen a huge uptick in the activity of corporate venture firms over the last couple of years as corporations are sitting on large amounts of cash on the balance sheet. Those groups typically can wait even longer than 10 years and invest for both financial and strategic reasons. But essentially, the goal is to exit these companies, and it's usually done either by acquisition, so a strategic group will invest into the company at an earlier round and follow the company along for a while as sort of an optionality approach, and then eventually acquire the company and bring it in-house. And much more rarely, and certainly this is evidenced by the activity in the market today, kind of Groupon excluded, I guess, in the near term, is more on the IPO side, and that's it's something that I think you'll see is very cyclical, depending on where the market is, and look at the sort of the valuation expectations that were placed on Groupon even going back 6 months, and with all of the struggles we've had in the public markets where the IPO market and pricing on that deal has gone over the last 6 months is evidence of just how truly difficult it is to exit through this method. Rapid growth rate in revenues over the investment time period. Again, exit multiples are typically what's used, a multiple of revenue at exit is typically what's used by the strategic acquirer or a financial acquirer. I didn't mention that. You could also exit a company by selling to another financial, private equity, or venture capital investor. And so the multiple of revenue or multiple of EBITDA is typically what's used at exit. So in the case of getting the best value for the company, you want to have as rapid of growth as possible over that time in revenues to kind of maximize that exit price. or terminal value. And in most cases, looking to be profitable within a short period of time. Certainly, it has become more important to focus on the types of revenue and the types of income and the recurring nature of that. I think those revenues are valued much more highly by strategics than sort of a lumpier, choppier revenue model. And certainly there are exceptions as are listed here in some of the internet companies. But in general, the focus is seeing a clear path to profitability at the point of making an investment and tracking that over time. And again, the last point on here, just making sure that you have as diverse a portfolio as possible given sort of the risk return of this asset class. So the next slide, calculating the post-money valuation. Again, Kirsty provided a pretty straightforward example here for $1 million investment in the company. If the company at a pre-money valuation is valued at $2 million, post-money is simply $3 million. Thinking about valuation and how companies set valuation from round to round, certainly it's the preference is to have valuation increase over time for the founders, for everyone involved to continue to have positive traction. And make sure that you've got continuing valuation growth, but down rounds occur when the pre-money valuation for the subsequent round is lower than the post-money valuation of the prior round. So that's just a couple figures on valuation. And then calculating the return on investment, the terminal value over the post-money valuation after the investment. The example here, $30 million post-money valuation, or a $30 million exit and a post-money valuation of $3 million. The return on investment is 10x that investment. So on the next slide, again, mentioning a few things here on calculating the industry to price to earnings ratio. This is a beer company example that Kirsty used, and taking a look at the market cap and trying to filter out the industry comparables, obviously based on the market cap, on the revenues, trying to find something that is as similar to your company in terms of size, in terms of stage as possible, and then coming up with a market cap as a multiple of that revenue in the fifth column here, and in the last column on the right, the multiple, the market cap as a multiple of EBITDA, and then coming up with a range of what these industry multiples are, ultimately determining what valuation you think you could ultimately exit the company for, and playing into or taking into effect what the expected revenue ramp is for the company, and that's certainly a key point in determining what valuation you have or can expect to get for a company, and then working backwards to get to a valuation today. So on the next slide, we provided a VC valuation method, and walking through this, simply an investment ask here, so $500,000 need to grow the business, the number of years to exit a business, 5 years, and that's a pretty average expectation, and typically based on the business plan. The expected revenues in year 5 of $50 million, and a net profit level of 10%, so $5 million. What that industry PE ratio is, going back to the previous slide, at 9x. Let's say this is a high growth industry and is paying a 9 times PE ratio, gets you to a company value at exit of $45 million. So what? And again, that's a 9x multiple based on the $5 million EBITDA number. And so what's required here in order to achieve a 30x multiple is $15 million, simply the $500K investment multiplied by 30 times cash on cash return expectation, and the percentage required by the investor to reach that goal. So what's the percent ownership? That $15 million over $45 million, so a third, and you could walk backwards to what that required post-money valuation should be at 1.5 million, sets a simple pre-money valuation of 1 million. So I think this does a really good job of laying out how investors, how venture firms think about valuation and how valuation centric they are in their approach. We've never seen a case where investors are come in above the valuation of entrepreneurs. Entrepreneurs are always more bullish on their company than the cynical venture firm is, and so certainly a huge gap typically in earlier stage companies. As you move on to a later stage round, it typically thins out a little bit, but I think this does a good job of showing how pre-money valuation is thought about by a VC. And so the next slide simply talks about dilution. I think this is a pretty straightforward example of talking about as you raise additional rounds. As you go here from a Series A to a Series B, Series C round, you can see what happens to the founders and the Series A investors. And one thing to note is that this does not take into account sort of stock option pools and warrants, any sort of shares that are in reserve on a cap table. And when you look at and why it's important to look at the fully diluted sort of share breakout and really take into account what this dilution does over time. I think it's one thing to note here is that it's incredibly important for venture investors to make sure that founders are maintaining a significant ownership piece. It certainly is not a good outcome if you get to a Series C, Series D round and the founders have not been mindful of structuring themselves into a significant ownership piece and having really retained some upside on the business when that company is sold. It certainly becomes more and more stringent on the venture capital firms become more and more stringent on terms and structure as they get into these later and later rounds, and so it's not too rare to see in a Series B or Series C round some restructuring around the founder ownership to make sure that they're protected and have significant ownership going through to an exit. On the next slide, you'll see a typical investment process. So how do you work through a venture capital process, and how long does it take to raise capital? I can't tell you the number of times investment opportunities will come in to Florida Growth Fund, and they're looking to raise capital, and the deadline is within a month, or they're going to run out of cash. That's not going to work. On average, it takes a primary investor about 6 to 9 months, I would say, of tracking a company over time. What we often message to groups in the market is that the best time to fundraise is when you don't actually need the money, and so making sure that you're on the radar with venture capital firms in your region or in your sector is important, because this process takes a very long time. It is you have to keep in mind that venture firms typically start at the top of their deal funnel with about 1,000 to 2,000 opportunities that over the 5-year investment period that they have for a venture capital fund, they'll look at anywhere 400 to 500 deals a year and really narrow that list down to 3-4 deals a year on average, and I'd say that might even be an aggressive pace, and that's more on the venture side. Angel investors typically might invest even slower or in less deals than that. So the time that it takes and the work that it takes to work through what you're seeing in front of you as far as the due diligence process and get through term sheet offering and getting a deal to be closed is a very long cycle, very long period of time, and so getting out in front of the market early on is certainly important. And I think that's it, Kirsty. Turn it over to John.
Yeah. Awesome. Thank you so much, Casey. Everybody, if you have, I know it's a very complicated topic, and it's difficult sometimes to go through this at the pace that we're going through today. So if you have questions, we're going to have some time at the end. On your screens, you should see a message box. Please feel free to type in any questions you might have. We will queue those up once we get through this last section here that John is going to cover. We'll have plenty of time to kind of throw those out there, and we can drill down on anything that you'd like to have us talk more about. So with that, I am now going to turn the floor over to John. As was mentioned earlier, John has spent quite a bit of his career working on doing these types of transactions in his role as an attorney and then also as an investor. So he is going to cover what one of these deals will look like to you as an entrepreneur or as a company founder, and what will be expected of you as part of the legal transaction. So with that, John, please take the floor, and you've got basically 15 minutes or so to cover your slides as well.
Okay, Kirsty, thank you very much. I appreciate the opportunity to participate in this program, and thank everybody from TRDA for putting it all together. I'm going to go a little bit off presentation to start because somebody asked for us to comment on the crowdfunding bill, and I just wanted to add a couple of things to what Mark said about that. It's a very exciting development for entrepreneurs and startups. The problem it addresses is the legal restrictions in offerings when you're trying to raise capital and sell stock. There's a restriction on general solicitation, which means you can't advertise, you can't send an email to all the doctors in your county, and you're supposed to have a prior relationship with the investors that you raise money from, either directly or through a broker. There's also disclosure requirements under federal and state laws, which makes offerings very costly. And intermediaries need to be registered broker-dealers. Now, the rationale behind these laws is to protect investors from unscrupulous or risky ventures. But the crowdfunding bill kind of reflects the reality of what's happened with social networking. If President Obama can raise his campaign funds at $5 a person, why can't entrepreneurs do it to build a business? The bill that was passed in the House, quick components up to 1 million or 2 million if you have audited financial statements in total. Each investor can only invest up to the lesser of $10,000 or 10% of his net worth. And then you have to address risk factors. You have to have your investors fill out questionnaires evidencing their understanding of the risks, and there's a filing with the SEC. And then real quick, if this becomes law, entrepreneurs are going to have to be very careful about planning, because it comes with some downsides. I mean, if you end up with hundreds of small stockholders, that is likely to be a big turnoff for venture or other institutional investors in later rounds. You have fiduciary duties to all of your investors, including what could be hundreds of people, and it's going to take a lot of time and distraction from management to maintain communications with this many people. And there'll be administrative costs. You probably need a transfer agent just to handle transfers when somebody dies, for example, even if you have restrictions on transfer. So it's a terrific development. It's a great idea, but it will come with the necessity for careful planning. To my presentation on classes of stock. Stock is really the evidence of ownership of the company. And you saw some pie charts in the earlier presentation. The key component with respect to stock is the number of shares issued and outstanding. And sometimes people talk about issued and outstanding on a fully diluted basis because you want a cap chart that takes into account the exercise of options that you granted or the conversion of preferred stock that's been issued. So when people say issued and outstanding on a fully diluted basis, they're assuming that all convertible securities have been exercised, and that gives you a picture of where you fit, what your percentage as an investor is in the company. With common stock, there are no special rights. It's just one share equals one vote generally. And founders, friends and family, angel investors traditionally, and stock option plans are almost always common stock. Preferred stock has rights, preferences, and privileges that are authorized under corporate law above the holders of common stock. They can have voting powers or rights senior to common stockholders. Most often you hear about a liquidation preference. That means when the company is sold or goes into bankruptcy, holders of preferred stock come out ahead. They have a liquidation preference. They get their money back first. Preferred stock typically comes with a dividend, an accrued dividend. It may be compounded, may just be, may not, but the dividends will give the preferred stock investor a built-in return on investment, above and beyond the appreciation of the stock, kind of like an interest rate. And you can have multiple series of preferred stock. You may have Series A, Series B, and Series C. As the company grows, you're appreciating in value, you hope, and so the price per share for each round increases. So $1 million of Series B gets me a smaller piece of the company than $1 million at Series A. The price to be paid for that is traditionally, if you put your money in last, you have a senior liquidation preference. Sometimes I refer to it as the LIFO of investment classes, last money in, first money out. I'm going to flip the chart. Examples of preferred stock rights. There's a tension here between what boards of directors are normally tasked with doing, what their authority, the authority of a board of director to manage the company, hiring and firing of CEOs, approving acquisitions or mergers. You also need stockholder control, but the tension comes in when a preferred stock investor invests. He's going to want they're going to want class voting rights. It's often called protective voting rights. So even though the board has to approve the hiring of a CEO, Series A preferred stockholders could veto that decision if that's included in their list of voting rights. You may also need preferred stock approval for stock option plans, issuance of new stock, especially because everybody's worried about the terms that you might grant to a new investor, approval of budgets, business plans, and major transactions, material transactions, including borrowing or licensing of technology. And also any kind of amendment to the charter, to your certificate of incorporation, or to bylaws. Those are the types of things that are included in the laundry list of protective voting rights. A liquidation preference, this can come in a variety of different formulas. A very common one used to be your liquidation preference was your investment plus the accrued dividend, or you convert to common. Preferred stock is always convertible to common stock, and that used to be a traditional approach. If the company did so well that the conversion to common was going to give the investor a much better return, then he would convert. It was a choice. If the company did not do well on an exit, he would stick with his liquidation preference, get his money back plus the dividend rate of return. However, that kind of evolved over the years, and you most often now see what's called the participating preferred. This gives the preferred stockholder their money back plus an accrued dividend and participation along with common stockholders as if they converted to common. Some people call it a double dip. It's really a mechanism for allowing a preferred stock investor to get to that return on investment that Casey was talking about, and you have to be very careful in negotiating this so that you know what's coming. Redemption rights, people talked about that earlier. You usually see the preferred stockholders have a right to trigger a redemption of their stock to require the company to buy their shares back in 5 to 7 years. You don't often see fights over this because the investors can't really force the issue if the company doesn't have sufficient capital to make it happen. So what it really is a prompt for planning ahead, so that management, knows that in 5 to 7 years, I've either got to, you either have to raise enough capital to take these people out, or you have to structure an exit, a sale of the company or an initial public offering. I'm going to the next slide. Convertible debt. Talked a little bit about this earlier. One of the advantages of a convertible debt investment at the angel or early stage is that it kind of eliminates the debate over valuation. You're in a very early stage. It's tough to justify a high valuation because you still have milestones to achieve. Well, if you can raise money from an angel group with convertible debt, they're deferring that decision to when third-party investors come in, so that it could give you time to achieve your proof of concept or a license agreement you're trying to execute, whatever that milestone is that gives you an uptick in value. Then you bring equity investors in, and the people who put money in on convertible debt then get to convert into that equity. And it may be because they took the risk early that they're entitled to a kicker, an equity kicker, and that could be in the form of a discount to conversion into the equity round, or it might be additional shares like a warrant. I'll talk about that on the next slide. What are warrants? Warrants are convertible. They are a security. It's like an option. It gives the holder the right to buy stock within a given time period. There's always an expiration date at a named price per share. I mentioned that they're often offered in convertible debt rounds as sweeteners, and people talk about warrant coverage. You'll hear warrant coverage expressed in the range of like 10 to 20%. And what that means is if somebody loans $1 million for a convertible note and negotiates 10% warrant coverage, then he will also get a warrant to purchase $100,000 of stock at some price, at whatever price is negotiated. If you're issuing warrants in conjunction with preferred stock offerings or common stock offerings or strategic deals, the company always wants to have the strike price high, above the current value, so that there's less dilution, but also an incentive for people to hold on to that warrant and exercise it down the road once the company appreciates in value. I'm going to flip to the next slide. Angels versus venture capitalists, some of the differences. I mentioned earlier that, in the old days, it was pretty common, it was pretty customary to sell common stock to angel investors. What we've seen lately, especially with the trend of the organization of angel networking groups or clubs or funds, is that they invested in common stock in the past, and then the venture capitalists would come in for the Series A round, and they just crush them. They wouldn't have any voting rights. Maybe they even lose a board seat if they had one. So angel investors kind of felt the sting at all of that and said, why can't we ensure ourselves a little bit more control? So you will see more often than not now angel investor rounds structured as Series A preferred stock rounds. You may be able to get a little bit better valuation from an angel investor than you would from a VC, but you'll often see the same types of preferred stock issues with angel groups now that you see with venture capitalists. There's a bullet point here about the entities. Obviously, if you're running a business, you want to have an entity, whether it's an LLC or a C corp or an S corp, so that the entrepreneurs can protect themselves from personal liability with respect to business creditors. And so the investors obviously will want that in place, and they will invest in entities. And all of what we've talked about with respect to convertible debt or common stock or preferred stock can be structured in any entity, in an LLC or a C corp. There's a lot of different tax issues involved, and I'm not going to talk about those now. We already talked about an exit. That's a redemption because of the fund life cycles. Basically, venture capitalists are fundraising all the time, just like their portfolio companies, and they raise money from institutions, pension plans, governments, and those people don't want their money sitting in a venture capital fund for 10 years. They want to get a return on their investment as well. So when you get money from a venture capital fund, you have to be aware that they will have pressure to find an exit, and you have to be prepared to deal with that. Angels do sometimes pass on a board seat, or you can get them to agree that they'll give it up when you do an institutional round. And venture capital funds always want representation in the boardroom with 1 or 2 seats. Next page. For closing deals, Kirsty, am I okay on time?
If you've got basically 2 or 3 minutes, and then we'll wrap up and go to questions.
I can wrap it up. That's fine. There's a lot of things on the agenda for a closing. On this first bullet point, I want to mention that before you even raise money, it's very important that all of the employees and founders sign non-disclosure, confidentiality agreements, and if you have anything to do with technology, an invention assignment agreement. So any work that anybody does for the company of an IP nature, that belongs to the company. That is critical, and investors are going to want to know that anybody who worked on your project from day one, engineer or technology scientist or whatever, has signed one of those documents. That's very important. And then Keyman Life, information rights. The investors are going to want the right to review your books and records at any time. It's got to be full transparency. D&O insurance, stock option plans in place. That will be part of the valuation discussion and negotiation. And then they want the company to pay their expenses out of their proceeds. It's going to jump. Some of the equity terms, we talked about dividends. They normally accrue and would be paid out on an exit event. I mentioned participating preferred, so we don't need to go over that again. Anti-dilution and pay-to-play, the pay-to-play is very prominent in the last few years. Anti-dilution means if you sell preferred stock at $1 a share for Series A, but then you have a downturn in your expectations and you've got to raise money at a lower price, there'll be a mechanism in the conversion formula that will trigger an anti-dilution adjustment, so the holders of Series A will also be able to convert at some price lower than $1. Redemption rights we talked about. Co-sale, sometimes called tag-along and drag-along rights. Real quick, if you're going to sell the company and the majority shareholders want to do it, and you have the preferred stockholders lined up, this then gives you the right to drag all the minority shareholders along into the deal. They get to participate, but they can't exercise dissenter rights to block it. The reciprocal is a co-sale or tag-along right. If the majority investors want to sell their interest, you can't leave the minority folks behind. They get a right to tag along. So a lot of these issues you're going to want to cover in a shareholders agreement at the founder, friends and family, and angel level before you get VC funding. So it's very important. My last slide here is a chart. And this is interesting. It shows since 1996 to 2006, not the aggregate number, but the ratio on exits of mergers to IPOs. And you can see in the heyday before the internet bubble burst in the late 90s up to 2000, there was a substantial portion of exits were done via IPO. After the bubble, that has gone down dramatically, and we've seen a couple of high-profile IPOs recently, but it still really hasn't come back to where it used to be. IPO is just not a common exit scenario now. And one other comment, if we had a chart that showed the number of exits, there would be you would see that during this economic downturn in the recession, the banks started holding on to their cash and stopped lending. What that did is, in the M&A world, provided less leverage for the private equity firms who need leverage for their models to work when they buy and sell companies. So there was a big downturn in M&A exits. It started to come back a little bit, but you need to have a thriving economy with flowing debt in order to have a lot of merger and acquisition exit activity. And the result with respect to what we've been talking about is when there's a downturn in M&A activity, then the venture funds kind of hold on to their money a little bit. They're not investing as freely because they're going to wait for that window to open so they can be more comfortable that they'll have an opportunity to exit. So I will sign off there, Kirsty.
Thank you, John. You're not questions. As the session's gone on, some questions have come in over the transom here on the message box, and again, continue to send those questions our way, and we'll get them out here to the group. I'm going to jump right in. There was a question, I believe this was targeting Mark's comment early on into the presentation, and the question was, is there a portal or a website to find out more about family offices?
I don't know that there's a portal or a website. That the first place I would direct anyone in the clean tech sector to would be a newly formed group called the Clean Tech Syndicate, and that is managed by Black Coral Capital, as well as I'm drawing a blank on the other group, but a multifamily office group that's out of Chicago. And if you search Clean Tech Syndicate, you'll certainly find that group, which purports to represent more than 30 family offices and billions of dollars in potential investment in the sector. So that's a material development. But specific to the clean tech sector, I think if you search the term family offices, you'll find some list on the internet in all likelihood of groups that classify themselves in that sector.
Thank you. Okay, so a question that also came in is, what is founder vesting, and is it required by angels and or VCs? And so, yeah, go ahead if somebody wants to jump in on that.
I'll take a stab at that. This is John Igo. Founder vesting means you issue stock to yourselves. The founders could do it at the outset and have it vest over time, which means there's a risk of forfeiture of the shares that aren't vested. So if 4 people get together to start a company, and then one of them just quits and decides to retire and surf in Hawaii, is it fair for that founder to hold on to the same amount of equity as the other people who are still manning the laboring oars, if you will? So vesting, if you impose a vesting requirement, it can be a good mechanism between the founders for dealing with the possibility that somebody might leave. Venture capital investors like to see that in place, and this was a trend started in Silicon Valley a few years ago, started to impose it as a condition. We're going to put our money in, but you got to we want vesting restrictions on all of your founder stock because we want to make sure you're going to be around to get us a return on our investment.
Thank you. Does anybody else have anything they'd like to add? Okay, next question. Could you provide more details on criteria that venture capitals look for as baseline conditions for considering an investment? So, Casey, maybe you can take that one.
Sure. I'd say it varies very much by stage. Venture investors typically like to specialize or focus on stage of investment, and so some venture groups will focus on true early stage, seed stage deals, some on much later, and then the criteria kind of self-selects from there which deals or company types are applicable. I'd say at an earlier stage, you're typically looking for, let's talk about across all stages, what criteria is important. Management team, first and foremost. I haven't met a venture group that their number one criteria is in finding a management team with great domain experience, expertise, that's been there and done it before. So I would say that's kind of across all stages. And then for early stage, you're focusing on deals where you're typically well past proof of concept and already have kind of close to anywhere from 1 to 3 million of revenue at that point in time, and early stage venture investors typically are looking to come in at that point and fund the execution risk because you're certainly past the proof of concept at that stage. Later stage deals, you start to trend upwards to 10 to 15, 20 million of revenue, seeing how that cash flows through to the bottom line. Are those margins expanding or contracting? And really at that point you're funding sort of additional growth. You're significantly mitigating kind of the execution and the technology risk at that point.
Awesome, thank you. Next question was, could you please address how corporate venture capital groups are compensated, and if is there a difference in the types of equity, the shares that they take, and exits and things like that?
Yeah, I can address some of that specific to Floater Growth Fund. Actually, within our portfolio right now, we have about 16 investments that we've made directly, and 3 of those are with corporate venture groups. Not as a lead investor there, but certainly they're invested either for strategic reasons or for financial reasons, or sometimes for both. A lot of times, a corporate venture group will come in and make an investment in a company as almost an option to invest or to eventually acquire a company. And so they typically are not looking to lead an investment round within a venture syndicate, and will sort of take a backseat to a lead venture sponsor in pricing the round, setting the terms. Certainly a lot of corporate venture groups, and especially with the advent of a lot of these groups over the last couple of years, their experience in direct investment, venture investing is limited, and they're more often a function of an M&A arm within that corporation. And so it's not really their place to determine what is market. And so I would say lead investors typically are setting that, and corporate groups kind of are, lead venture investors are setting that pricing, those terms, and either bringing in a corporate VC, or if a corporate VC is taking a look at the deal, they might look to that lead investor to kind of set the round, set the terms, set the pricing.
Okay. Do corporate venture capital firms ask for intellectual property ownership as part of the compensation that they're after?
I would say in our direct experience, we have not seen that, and I think the corporate VCs we've invested with have been more on the side of investing for financial return and less for strategic reasons. But it's certainly it's not outside of the realm of possibilities.
Okay, yeah, we have one of the listeners is poking at that in particular. Sounds like maybe they're running into that. So, okay. So the next question: what are the top 3 mistakes entrepreneurs make when they approach an investor? Maybe all 3 of you guys had, Mark, from the entrepreneur's perspective, as well as the investor, and definitely the other 2 from the angel and VC perspective. If you guys could each chime in and maybe just give some, quick bullet point, mistakes you've seen. Let's start with Mark.
Yeah, well, I'm happy to give one. I think there's a lot of statistics that you hear about the number of groups that you should approach in order to be successful, and they're usually somewhere in the magnitude of, you approach 30 sophisticated investors, and you'll get a meeting with 6, and 3 will be interested, and 1 will fund, and all that stuff. I've never known that experience to be accurate, and others certainly can weigh in. I think one of the mistakes that companies make is not spending a lot of time up front on the types of investors that fit both the profile of the project you're trying to put together and the investment category. I mean, it's venture capitalists are never going to understand your business to the extent that you do, but you can save yourself a lot of time, I believe, by focusing on groups that have a specialization in what you're trying to get funded, that will be quick on the uptake and kind of have an appreciation for what you've done in order to make an investment.
Great. Thanks. John?
I guess one pet peeve I have is there's so many business plans. You see people saying, look, all we need to do is get 1% of the market and look how much money we're going to make. It's as opposed to, detailed planning and analysis of marketing and sales and strategies and action items and how you're actually going to get to your projections, as opposed to, it's no big deal. All we need is 1% of the market. We're all going to be millionaires.
Great. Thanks. Casey?
Yeah, I'd add one point that I think is an add-on to John's, and I think that's understanding the competitive landscape. I think we've come across a number of companies that are here in Florida, high growth, great management teams, but not really understanding just how competitive a market environment is that they're entering. Or it's much easier to see out in Silicon Valley or maybe up in Boston, New York, some of the other areas that concentrate a lot of venture capital investing, that you can. It's easy to see which other companies are in your space, in your sector, and have great management teams that could move into that sector. Oftentimes companies will come to us and we know that the business plan or the objective is going to change over time. And so really understanding kind of what the competitive landscape looks like in terms of not just businesses that compete now directly within your space, but companies that could pivot into that space very quickly. And that does not have to include venture-backed groups. That can include spin-outs of larger corporates, strategics, etc. And so getting a full grasp and understanding of the competitive landscape, I think, is important.
Great, thanks. Okay, last questions around the tough topic of valuation. Can you share some misconceptions that you've experienced by entrepreneurs on how they value their companies and what a company should be thinking about when they're asked by an investor, what they think their value is? Anybody want to go first, or do I get to pick?
Yeah, I can take a crack at that, Kirsty. This is Casey. So I would say probably the most common misperception that we see is a very high valuation expected early on, and it really is important to remember. So building this business over time, and that there will be subsequent rounds, and certainly understanding the downside, and as you're working through sort of the different cases and scenarios, how much capital it's really going to take to build this business and get to an exit point, and that setting a high valuation early on will scare off future investors, whether those be strategic, corporate, high net worth, regardless. And so one of the biggest issues I'd say we see is groups coming to us that have attracted angel financing or angel investors, set a very high valuation on the business, and it scares off corporate, or I'm sorry, venture syndicates at some of the later rounds.
Okay, great. That's the end of the question list we have here. I'm going to turn the floor back over to Bernie to wrap up both today's session as well as the webinar series in general. So, Bernie?
This is Bernie Zuzo. I want to respond to one last question, and it had to do with whether this webinar would be recorded as other webinars have been, and the answer is yes. In a few days we will have the recording prepared for viewing, and we will have the slide set prepared for you as well. I'd like to thank Kirsty and the wonderful team she put together with Mark, Casey, and John. All of the time and effort they put into preparing and presenting today's webinar on financing technology ventures. Thank you very, very much. For myself and on behalf of Chester Straub, Executive Director of TRDA, and the TRDA staff, I want to thank all of you for attending today's topic, and those of you who have attended the entire series, thank you as well. We wish you good luck and much success in all of your future entrepreneurial endeavors. And that's a webinar.